NOCIL, the largest rubber chemicals producer in India, has reported a strong sequential improvement in a very competitive environment, and that's mainly led by the volume growth. In our ideas for profit today, we'll discuss if the stock really warrants investors' attention, and that's post the Q2 earnings. Well, the Q2 sales jumped 108% sequentially, backed by a similar growth in the sales volumes. The quarterly sales volume at 115 tons was the highest so far and exceeded the average run rate of 100 to 105 tons per quarter. Now, the EBITDA margins have also recovered closer to the pre-COVID levels. However, they are a far cry away from the levels prevailing a year ago. Now, the last phase of the company's mega capacity plan, worth about 425 crore rupees, is near completion. The phase 1 of the capex project has already started the commercial production, and the new capacities have also an expected asset turnover of about 1.8 times. The company has no incremental plan for capex and will continue to focus on increasing the utilization levels in the coming years. So the end of the cycle of capex actually means that FY21 will be a year of free cash flow generation. However, given the sharp drop in the rubber consumption due to the pandemic and now a gradual pickup, the peak utilization for the new facility is only expected to take 4 to 5 years. Now, the management is confident of posting sales volume numbers in FY21 that's similar to FY20. Now, in spite of the weak Q1, a better volume growth in the remaining quarters is also expected on the back of a pent-up demand and also the trend towards personal mobility that is really helping the auto end market. Further, as tire imports are still under the restrictive list, the domestic tire industry is also expected to be in a better place to increase the production therefore. Now, this should actually lead to a higher domestic demand for rubber chemicals as well. Moreover, the demand for non-tire applications such as medical gloves is expected to remain healthy in the near term. Now, on the export front, inquiries from new customers have also increased as many clients now want to contain the China supply risk factor right now. Earlier, a major client had also revised the status of the company from being a regional supplier to a global supplier. Now, though export volumes to the US at present are still minuscule at just about 1,000 tons, the opportunities due to the China Plus strategy of tire makers to really procure raw materials is a great space and a key aspect to watch going forward from here. A good part of the increase in sales volume in Q2 can also be attributed to this phenomenon. Now, over a period, the management also is confident of business inquiries getting translated into commercial opportunities for which it has enough capacity bandwidth right now. Having said that, a number of factors really need to be monitored by the investors. First, the largest rubber chemical manufacturer, Sunshine, having about say 75% market share, that continues to operate at the full utilization levels, and that is even though the global demand is largely subdued at the point in time. Further, the last year's removal of anti-dumping duty has also led to an adverse demand supply situation right now. Nevertheless, the company's volume focused strategy is bearing result, and hence the domestic market share has also improved to around 40%. Now, the company is also expecting a price hike for Q1 FY21 or Q4 FY21 as a major competitor has already initiated the hikes across the board. Now, in the near term, the operating margins for the company will be lower than that of the prevailing FY15, FY16 before the anti-dumping duty on rubber chemicals was really levied, which was actually removed back in July of 2019. However, for the next fiscal, we also expect better margins on the back of the operating leverage, also the potential benefit in case of imposition of the anti-dumping duty or on the antioxidant PX13 and also the price hikes. Now, for the long run, NOCIL is expected to maintain its dominant position in the Indian market or the domestic market due to its technical or technological leadership, the client relationship that it has, also the government's key focus on the import substitution. Now, NOCIL is emerging as a secured rubber chemical supplier for the tire companies. Any faster execution of the China Plus opportunity will be a great trigger for re-rating for the company. Now, coming to valuations. The stock is trading at around 10.7 times EV to EBITDA for FY22 estimated earnings. Now, though these valuations are not really inexpensive at this point in time, we are really turning constructive on the fact that the stock, given its better execution on the volumes at a reasonable operating margin and the prospects of a pricing-led recovery going on from here. So that is something that all the investors should really focus on when you think of adding this stock to the portfolio for the long term.